Anil Agarwal talking about crude prices, but let's really put it into context, not just for India, but what these developments over the weekend could possibly mean for the world economy. And for that, we've got Sharmila Whelan. She's the Deputy Chief Economist at Asianomics Group. And also joining in on the phone line is a Senior Energy Analyst at Interfax Global Energy, Abhishek Kumar. Both of you, thank you so much for taking the time out for us. Sharmila, let me begin by asking you, this 90-day ceasefire or trade truce, whatever it is that you want to call it, between the US and China, seems to have sparked off an early Christmas rally, if you like. Are the markets getting ahead of themselves here a little bit, you think?
Well, Tanya, you said the words, an early Christmas rally, and as we know, Christmas comes once and then it's over. So I see this as a short-lived rally. The market is taking comfort from a couple of things. First, that there's been a truce at all. Again, the agreement, they were expecting something really, really vague as a baseline case, which would be welcomed as positive, but you've got a bit more details. You've got the U.S. saying that the Chinese are going to import substantial agriculture, industry, and energy outputs. China's agreed that both sides need to open their markets. Both have pledged to negotiate on, forced technology transfer, intellectual property rights, all that. Plus, the Chinese seem to be more open to approving the Qualcomm NXP deal. So, the market's got a bit more than it was expecting, and it is rallying. But, as you started off saying, it's a 90-day truce, and that's very, very tight, and it wasn't expected.
Okay.
And moreover, there's gaping divisions between what the Chinese are willing to give and what the U.S. wants. And you can see it very clearly today in, how each leader is selling the agreement in their country and to their, people.
You're right, absolutely. The versions being put out by both the countries are also very different. But, before we talk about that, let me take it across to Abhishek. And Abhishek, stocks are rallying hard and so is oil. Of course, it's come off a little bit, but the fact remains that oil isn't just, on a winning streak because of this confidence boost that this trade truce has brought about. But you've also got Saudi Arabia and Russia extending their pact to manage the market. And then there's Canada's largest producing province that's, ordered some unprecedented output curbs. Having said that, would you say that, this rally that we're seeing in oil might also be short-lived?
I would say that it is a short-lived movement. However, the trend is looking upwards, like moving ahead into next year. So there are quite a few factors. So if we look at, for example, the most important factor at the moment is the OPEC meeting, which is going to happen in the next few days. And all the indications are that OPEC is going to deepen cuts. We are still awaiting what form it's going to take, but that's the general direction, and that will be supportive of prices. And then the U.S.-China trade war and the recent developments, we have seen a lot of talk about the truce. So that's also supportive of prices. However, whether that's a long-term factor or not, still to be seen. So I think those are the two factors we should be looking in the near term. Moving a bit longer term, then we need to focus on Iran and Venezuela and what's happening with the production declines. And at the moment, the waivers are given to Iran, and when they expire, then the impact of that on the oil market will also be bullish on prices. So that's another bullish factor. So sure. we should expect a gradual improvement in prices moving forward. No sharp increases, though.
Okay. Sharmila, let me ask you, coming back to the armistice between the two countries, who do you think at this point has the upper hand? Because, the fact is that 90 days to work out a broad agreement is just not sufficient. You're talking about wide-ranging bilateral agreements like, the theft of intellectual property and forced technology transfers in JVs.
Well, I'd have to say that the U.S. has got the upper hand here, and it's not just because, it's China's running a bigger, a very big trade deficit with the U.S., and therefore the U.S. has, more to play around with in terms of tariffs. It's got, $250 billion. They've already imposed tariffs on. There's another $267 billion that they could impose tariffs on. So far, the Chinese have only imposed about tariffs from their side on about $110 billion, and they're going to reach a ceiling very quickly. They can't compete with China, with the U.S. on that one in terms of who's got more tariff slapping power. But I think more than that, where the U.S. has got leverage, more than just purely goods, I think what's less appreciated and what matters to the Chinese much more is the control that the U.S. has on technological transfer and on intellectual property rights, and on imposing non-tariff barriers. And because remember, Xi Jinping, his big vision is China 2050, China 2050, where the whole made in China, and wanting to upgrade the whole manufacturing stroke industrial sector to higher value added growth and high tech. And that's very much dependent on technological transfer from abroad. And that's where the U.S. has got leverage. And you're already seeing the EU in this debate aligning with the U.S. And I think that's what will bring the Chinese to the table to negotiate. They're more worried about that than about pure tariffs on goods,
okay,
I would say.
Right. So the U.S. is the upper hand. Abhishek, the other news, that's come about today is the fact that Qatar says it's going to quit the OPEC after more than 57 years of being part of that bloc. Of course, Qatar is denying any decision that's related to Saudi-led boycott. My question is really twofold. One, what's, made this decision come about, and how much of an impact is it going to have?
Okay, so there are two aspects of it. One is on the fundamental side and one is on the geopolitics side. So on the fundamental side, in terms of oil production, there is unlikely to be any impact at all, whether Qatar is within OPEC or it is not. So if we are looking at Qatar's oil production, that's around, say, 2% of total production by the OPEC. So that's really small, and that has always been the case. So, however, what has changed? So we should be asking this question. So why did Qatar decide to leave the OPEC? And whether they agree or not, it is a lot of geopolitics involved over here. So we have already seen the impact of the geopolitical dispute of Qatar with some of its Gulf neighbors, and what's happening, for example, in the LNG market. So since those embargoes were imposed, Qatar has not sent any LNG cargo to a country like Dubai, which is part of the UAE. So Dubai is suffering from the loss of a cheap source of LNG supplies. So that is affecting the allies of Saudi Arabia. So the latest move can be seen as, in a way, Saudi's response to what Qataris have done. Now, another element of this is the position of Iran in all this dynamics. So Saudis and its allies have often criticized the closeness of Qataris to Iran. And if Qatar is not part of the OPEC, then that certainly strengthens the hand of Saudi Arabia within the cartel. So that's another element of this whole saga. So it's a lot of geopolitics going on, not a lot in terms of fundamentals, though.
All right. Abhishek and Sharmila, I'm afraid we've completely timed out for this discussion, but thank you so much for taking the time out and joining in here on India Tonight. Well,